Hey everyone, in today's episode I want to cover the topic of buying versus leasing. This is a very common problem, very common conundrum that a lot of my construction clients run into is should I buy or should I lease that next hauler, excavator, truck, insert name of very expensive machinery and equipment here. And so on that note, the topics I want to cover are the pros and cons of each, a tax analysis of either option, a real life example, and there's also a little bonus that I want to throw your way. The three main criteria you want to look at are your cash flow position, your tax position, and the growth stage of your business. Now, with respect to each one of those, let's go down the pros and cons of either buying or leasing. Now, the first pro with buying is it's an asset on your balance sheet, you're building equity, and you control how long you have that equipment or machinery. Secondly, with buying, you actually, from a tax position, you are more advantaged, especially in 2025 going into 2030, because basically for every one of those years, you can expense between Section 179 and bonus depreciation, you can expense the full value of that machinery, equipment, or vehicle, potentially vehicle if it's over 6,000 pounds, in that year of purchase, whether or not you actually paid for the full price in that year of purchase. Now, so you're actually, you're having an asset on your balance sheet. Tax-wise, you're having a very generous tax write-off. Okay, so these are definitely the pros of buying your very expensive fixed asset. Now, the cons. There's obviously a very large cash commitment up front. So cash flow-wise, it will definitely in the beginning put you at a worse off position. Also, please note that when you buy it, originally you get to expense the full deduction. However, based on your tax position in that year, if you're already at a break even, if you're at a loss, that provides you no benefit in that given year. So now you've gone backwards, in terms of cash flow, and you've had no help tax-wise. So that's almost a double negative right there. Finally, always remember that when you buy, this machinery, equipment, truck, whatever it is, you are going to be responsible with the repairs, the maintenance. That's all on you. So anytime something goes wrong, you're going to be financially responsible to go and get this thing fixed so that it's functional again. So putting all these factors together, buying makes sense when you're already profitable in that year. You're anticipating a larger than usual tax bill, and you see the need for this machinery and equipment in the foreseeable future, at least 2 to 3 years. Now, let's get into leasing. Leasing, the pros. The upfront cost is much less. It's much easier to get into. It's much more flexible. Usually there's some down payment involved, maybe 1 month and a smaller fee. And, you're basically almost just renting that equipment, for the foreseeable future, for the lease term. Also, the payments are steady and predictable. You know exactly, what you're paying every month. A lot of times the repairs are covered. Depends on the agreement, but you're not on the hook completely on your own to go make all the fixes yourself necessarily. The lease payments are fully tax deductible, but when you put them side by side, so there is a tax advantage involved. It's you almost think of it like rent. So when you're making a rent payment, you deduct the actual expense, actually what you paid in that period. So it's very similar with a lease. So you're basically just deducting what you pay. Now, it's not as generous of a tax write-off as buying, which allows you to front load the full depreciation. However, there is some tax benefit involved. Now, the cons of leasing is you don't get the full tax deduction like I mentioned. And also over the long term, if you see things really picking up next 2-3 years, generally you would end up paying more for that item in the long run than you would have if you were to buy your own equipment. Now what I want to do is I want to summarize all those points in this table down here, and let's go over it real quick together. So buying versus leasing. So upfront cost, With buying, you have a higher upfront cost, including the down payment financing. The leasing, it's usually just first month, small deposit, so definitely leasing wins there. Ownership, obviously buying, you build equity over time. Leasing, you don't have any ownership at the end of the lease term, you basically hand it off. Sometimes there are, bargain purchase options, things like that. There could be these situations, and it depends on the lease contract, where if it's more economically beneficial, um, you know, uh, effectively like the present value of the economic life, you're gaining most of the benefit, that is a de facto purchase. So just because the terminology says lease doesn't necessarily mean it's a full-blown lease. There are accounting nuances where it could be considered a full-on ownership, like a $1 bargain purchase option at the end of the lease, things like that. But anyways, I digress. So let's move on. So tax deduction, buying definitely has more advantage there. Between Section 179 and bonus depreciation, especially in 2025 to 2030, where you could effectively depreciate the whole amount up to a $2 million purchase in that year of purchase. It takes the cake there. Leasing, you just get to deduct whatever you paid monthly. Cash flow impact, so buying, obviously that gives you a heavy hit early. Leasing, it's more predictable, but the payments are generally less over the term. Long-term costs, buying is usually lower, leasing is usually higher. Flexibility, buying you own it long-term, leasing it's easier to upgrade or swap. So if you don't see the need to have this exact equipment 2-3 years out, maybe the dynamics of your business is changing a lot, maybe there's uncertainty, in that way, leasing might be a better option. So, in terms of like the tax, so the bottom line is if you're having a profitable year, it's going to make sense. If you're having a profitable year and you're in a good cash flow position, it might make sense to go ahead and make a purchase. However, if cash is tight, if you're trying to be flexible, fluid, you're still scaling, you're still building, you're still trying to, piece things together, things are a little uncertain for now, all your relationships are new, like leasing might make more sense. And just when you go to a dealership, these guys will try to sell you on anything. They'll tell you anything. They'll say, you get the tax write-off, you get this, you get that, but they just don't know your exact personal situation. So if you are in a break-even situation, tax-wise, tax and accounting-wise, that tax write-off could be a big mirage. It could be something, potentially you could carry forward and benefit in future years, but that year you're going to be out a lot of cash and you're not going to get the tax benefits, so it's really going to hit you hard. So, these are all like good criteria, to utilize. So let's walk through one example together, like a very, very simple example, and you'll see. So let's say one of our clients, a concrete contractor, needed a $100,000 truck. Here, I'm putting the example down here. So if he had bought that $100,000 truck and he would have used Section 179 depreciation, which is that big write-off and bonus to get the $100,000 deduction, even though he didn't pay the full 100 in that year. So assuming he had at least $100,000 of taxable income, he would have saved himself $30,000 between federal and state. Assuming you're in California, about $30,000 roughly between federal and state. But however, his cash could have dropped like a decent amount between like down payment, everything, like easily, $20,000, let's say. However, if he leased it, he would have been out like, say $3,000 deposit plus $3,000 a month, whatever it is. And, going back to the purchase example, $20,000 down payment plus the monthly. If he leased it, he would have been out $3,000 a month, at say $3,000 deposit and $3,000 a month, and he gets to deduct all those payments. So leasing is definitely simpler. Simply put, like you would buy something if you're in a more advanced stage of the business and you have the cash to weather it and you have the certainty, all that. Now, I know these are all like kind of soft factors, soft criteria, and you know your situation best. you got to think about it, like what you feel most comfortable with. Obviously, the name of the game of any business is cash flowing. If you can't cash flow, it's game over. As long as you're cash flowing, you're in business, you're good. That's the biggest thing. And everything else follows after that. Just scaling, growing the top line, making things more efficient, making things more cost effective, fulfillment. But in any case, but I do want to point you in one direction, which is like, these are all soft criteria. Think about your situation. I'm happy to speak anytime. Feel free to book a time on my calendar, reach out. But I did put together a calculator that you can plug in the actual hard numbers between your financing option and your leasing option, and it gives you net present value comparison between both options and tells you which is the more financially rational way. And I'm going to put that link down in the show notes, so you can go there, click on it, click on the link. It's on my website, but it's not a readily available link, so it's kind of only really available to my YouTube viewers. So feel free to do that. And thanks for tuning in again. I'm happy to have you here. And just reach out if you have any questions. Hit like, subscribe, turn on notifications for any tax updates, and I'll see you in the next one.